Hello, this is your daily dose of financial market trends. Canadian businesses are preparing contingency plans for 50% U.S. tariffs, while Apple and Broadcom are making waves for completely different reasons. Here's what you need to know this Sunday morning. Markets are closed today for the weekend, but let's look at where we stand heading into the new week. Friday's close had the S&P 500 at 7,785, down about 0.2%. The Nasdaq finished at 26,729, off 0.3. The Dow closed at 53,732, down 0.2. Meanwhile, the VIX dropped nearly 3% to 14.25, and the 10-year Treasury yield climbed to 4.7%. Starting with Apple, which is lighting up across multiple signal channels right now. The stock edged up 0.2% Friday, but what's more interesting is the surge in attention. It's getting across social platforms and the geopolitical cross-currents, swirling around tech hardware. With trade tensions heating up and supply chain questions resurfacing, Apple's exposure to both manufacturing dependencies and consumer spending makes it a bellwether worth watching closely right now. Broadcom had a rough Friday, dropping nearly 6% on volume that came in well above average. The semiconductor giant is catching attention not just for the price move, but because it sits at the intersection of several themes investors are wrestling with. Chip stocks are navigating questions about AI infrastructure spending sustainability, geopolitical supply chain risks, and whether the massive run-up in semiconductor valuations has gotten ahead of fundamentals. When a name this size moves this much, it often signals broader sector sentiment shifting. NVIDIA continues to dominate conversation ahead of its earnings report on August 26th. The AI chip leader is showing up everywhere as investors position for what's become the most anticipated earnings event of the season. Federal Reserve policy decisions matter enormously for NVIDIA's valuation, given its premium multiple. And any hints about the pace of AI infrastructure investment will move not just this stock, but the entire technology sector. The company has become the de facto referendum on whether the AI spending wave has legs or is starting to crest. Alphabet is in focus after reports that co-founder Sergey Brin is pushing the company to double down on its Gemini AI initiative. The stock dipped slightly Friday, but the strategic questions are bigger than one day's price action. Google faces pressure from multiple directions, including open source AI developments coming out of China that could disrupt its competitive moat. How the company allocates capital between its cash cow search business and expensive AI R&D will determine whether it leads or follows in the next phase of tech evolution. Let's zoom out to the bigger forces shaping markets. First, the Iran conflict is creating real disruptions in energy markets, particularly around oil flows through critical shipping lanes. The bull case, which strategists are assigning about a 25% probability, envisions a brokered ceasefire within 30 days that normalizes Strait of Hormuz shipping. If that happens, oil prices could drop 15 to 25% as supply fears evaporate, giving consumers more spending power and letting central banks stay accommodative. The bear case, running closer to 45% probability, sees the conflict escalating to directly threaten Persian Gulf shipping or damage Iranian oil infrastructure long-term. That scenario could push Brent crude above $120 a barrel, accelerating global inflation and forcing central banks to keep rates high even as growth slows. Second, U.S.-Canada tariff escalation is moving from theoretical to operational as Canadian companies draw up contingency plans for potential 50% U.S. tariffs. The bull case, around 40% likely, assumes the administration opts for targeted sectoral tariffs below 25%, with carve-outs for integrated supply chains. That would preserve the automotive and industrial networks that span the border and keep North American equity markets stable. The bear scenario, at 35%, envisions the full 50% tariff imposed broadly. which would hammer automotive and construction sectors with input cost inflation, while triggering retaliatory Canadian tariffs on U.S. agriculture and energy exports. Third, Federal Reserve policy direction remains the gravitational center for all risk assets. The bull case, at 35% probability, sees upcoming Fed minutes signaling confidence that inflation is trending toward the 2% target, opening the door to rate cuts within 2 quarters. That would compress Treasury yields and lift growth stocks on lower discount rates. The bear case, running 40%, has the Fed emphasizing persistent inflation risks from AI infrastructure spending and tight labor markets, keeping rates higher for longer and pushing rate cut expectations into late 2027. That would pressure high multiple tech stocks, even as financial sector margins benefit. 30-year mortgage rate sits at 6.67%, and housing inventory has climbed to 9.3 months of supply, well above the balanced market threshold. The lock-in effect is intensifying as homeowners with sub-4% mortgages refuse to sell, creating a gridlocked market that's stagnating rather than growing. Earnings calendar is quiet this week from our tracked watch list, but NVIDIA's report on August 26th is already casting a long shadow over position. Wrapping up with 5 things worth keeping on your radar. 1. Energy volatility isn't theoretical anymore. Geopolitical risk is translating directly into oil price swings that will hit everything from airline margins to consumer discretionary spending. 2. Semiconductor stocks are facing a valuation reckoning as investors question whether AI infrastructure spending can justify current multiples, especially with rate cut timelines getting pushed out. 3. Trade policy is moving from headline risk to operational reality for cross-border manufacturers, particularly in automotive and industrial sectors, where supply chains don't respect national borders. 4. The housing market lock-in effect is becoming a structural feature, not a temporary quirk. Expect continued inventory constraints and price stagnation as long as rates stay elevated. And 5. Fed policy remains the ultimate driver for duration assets and growth equity valuations. So pay close attention to the language in upcoming minutes about inflation, persistence, versus trajectory toward target. As always, this is educational content, not financial advice. Do your own research and consult a professional before making investment decisions. That's your Morning Market Digest for Sunday, August 16th. We'll be back tomorrow with another update. Trade safe out there.